the macro and the micro. How's the economy? What's the rates picture? Will they or won't they? And on a single stock level, are stocks reasonably valued, and how do we think about that? We're going to discuss that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic, sponsored by OptionPlay. Today I'm pleased to be joined once again by my good friend, colleague, Mark Guthner, who's a professor at Rutgers teaching financial practice over there. Mark has a couple thoughts he's going to be sharing with us. Before we get to that though, I just wanted to remind everybody, be sure to put your comments and questions into the chat because I think this is a valuable opportunity to get some of Mark's thoughts. So if you have any questions, and those could be economic questions, those could be questions on single stocks, those could be questions on crypto, because Mark, among other things, runs a finance lab at Rutgers, and they do some things like cryptocurrency mining and things like that. So really interesting stuff. Mark, great to have you here. Welcome.
Oh, thanks, Mike, and good to see you again.
Yeah. So I'm just going to ask you four basic questions. And the first question really goes to this rates picture, the inflation picture that we were talking about, this sort of will they or won't they? And I think when we think about whether we're going to get a rate cut, whether we won't get a rate cut, what we really need to know first is, are policymakers in an accommodative posture, or are they in a hawkish posture? A lot of people think that rates need to go down because they're in a hawkish posture right now and they need to become more accommodative. Is that actually an accurate assessment? What's your take?
I don't hold that view. I think that most people have that view simply because long-term rates like 10-year bond rates and short-term rates like bill rates have gone from a few basis points up to 4 or 5%. And just because rates rose doesn't necessarily mean that rates are tight or monetary policy is tight. It has to do with the amount of money you're printing and the relationship between market rates and inflation.
Yeah, I think we have a couple. Charts that we can show, and we'll see whether we can get a look at the things that you're talking about.
So I think this chart here tells a lot, Mike, because rates went up a lot. You think about 10-year bond yields being down at 50 basis points, a ridiculously low interest rate, and 3-month bill rates were essentially zero for quite a long time. And now 30-year bond rates are up to 4.5%, 4.6%. I started in the bond business trading bonds for pension funds, and rates were in the double-digit era when I traded bonds. From my perspective, rates are more, if you just want to say historically, probably a little bit less than average over the last 30, 40 years. Say since 1970. But I think what's important is you've got to compare rates to nominal GDP. This was something that was pointed out to me by a really terrific economist named Mick Levy. And in any event, what he pointed out was that over time, 10-year bond yields tend to hover around nominal GDP rate. We can see here going into the 1980s where GDP was growing faster than 10-year bond yields. And that's an indication that rates were too low, monetary policy too easy. And we've got the big blast of inflation that occurred in the 70s and finally peaked out in the early 80s. And then that's when that whole picture flipped around, where rates were higher than nominal GDP. Then inflation relentlessly fell from about 1980 till a couple of years ago. And here we are where inflation has ripped higher, and it's higher than nominal GDP. So I would make the argument that from a rates perspective, monetary policy is accommodative. and it's one of the reasons why the economy is doing so well, and um, um, employment is doing so well, and company profits are doing so well.
Yeah, actually, just a quick follow up on that. I mean, with respect to the economy doing well, jobs doing well, uh, is it really, or is this a little bit of a mirage? So, a lot of the jobs that I think I've seen are either government job ads or government related jobs, for example, in the healthcare space. Is that also what your data suggests, that the economy might not be as strong as the headline numbers suggest? How do we account for the disconnect between how people are reporting they experience the economy versus the headline data?
Well, first of all, I think if you want a job, you probably can find a job. It may not be exactly the job that you want, but you can probably find a job. I think the pain people are feeling is inflation. Um, uh, Prices have gone up an awful lot since the COVID lows of 2020. And people are hurting. Rents are up 30, 40%. I just got an increase in my long-term care bill today of 20%. My car insurance is up, I think 18% in the past year. And I can certainly tell you that the school is not paying me, increasing my pay at high double-digit rates. And I think that's what people are feeling. They're seeing a lot of things go up in price, whether it's food, whether it's fuel, insurance, health care. And that's where the pain is coming from. And I think, unfortunately, there's more inflation ahead of us. And the reason why I think that is because the Fed is still creating money, but that alliance between the federal government and the Fed. So the Fed creates money, and what we like to call it high-powered money, when they buy Treasury bills, and then they turn around and issue Federal Reserve notes. So those are the little pieces of paper that you have in your wallet, or the digits that show up on your computer screen when you go online and take a look at your bank account. So the amount of money in circulation right now, since 2020 is up almost 76%, whereas prices are up about 21%. And so that tells me that there is some, let's call it, pent-up demand for more inflation, that there is plenty of cash out there to fuel higher prices. Now we can see this chart here is a chart of the Fed's balance sheet, and we can see that the size of their balance sheet is coming down. They're trying to take back some of this money they jammed into the system. But as we see, balancing out, they're still 76% higher than when this massive money printing took place to deal with the government's budget deficits and the stimmies and all the free money that the government passed out. And of course, we know that there's no such thing as free money. And you can see that here, that the way the government went on an incredible spending spree. The deficit got up to about $3.5 trillion. I guess that was in 2020-21. That's coming off a little bit now. And so it's only to 1.6 trillion. The Federal Congressional Budget Office says that's going to be about 1.6, 1.7 billion in fiscal year 2024. I don't think so. I think it's going to be over 2 trillion, but notwithstanding that, that's all going to lead to more money, more in the system, and more inflation. So I'm not one to think that inflation is coming down. I don't think we're going to get rate cuts this year, and of course, that's not what is let's call it consensus expectations is these days.
Yeah. So as a follow-up to that, obviously one of the things that we're contending with right now, in addition to basically the federal budget, to monetary policy is geopolitical risk. We have war on the continent in Europe. We have war in the Middle East and possible conflagration of the war in the Middle East. What is the history of wars and inflation as well? How should we think about that?
Well, I would say that the two are joined at the hip. We have a good history here of our experience in the United States. And so if we look from the founding of the country, at the Declaration of Independence and signing, we had inflation in the United States as the colonists prosecuted a war of independence. Then when they started to pay off their debts, the price levels came down. It was not just inflation coming down, but prices actually came down. So we had like negative inflation. We had another bout in 1812 where the U.S. government had to prosecute the War of 1812. They took on a lot of debt and prices went up. And as they repaid that debt, prices came back down. We had the same phenomenon in the Civil War. The Civil War came along and the government needed a lot of money to prosecute that war, so they issued a lot of notes, and they even issued a currency bill that was not connected to gold. But once that war was over, the government paid off that debt, so prices came down. Happened again here at World War I. And that was shortly after the Federal Reserve was created. And from that point forward, yes, after World War I, the debt levels relative to GDP came down a bit. But you can see from this chart, nobody really cared about inflation so much anymore. Because if we go look at the inflation rate in the United States from the founding of the country to 1913, the average inflation rate was essentially zero for that entire time. Price level did not change. We, of course, had a big bout of inflation during World War II, and that whole process has came on because we know the government doesn't care to repay its debts anymore. It's only a matter of how fast they want to increase them. And as you can see, that's devastating to the Consumer Price Index, which just relentlessly rises now. And that really hurts people who are dependent on wages to pay their bills, as opposed to having assets like stocks, real estate, etc.
So it would seem from this chart, I mean, whatever the cause, first of all, we know that war, governments accrue debt during war. But based on this chart, you would say that inflation is largely just a function of debt then, sort of the aggregate debt level.
At this stage of the game, and then when we have wars, the governments increase their debt levels faster, so we have the potential for acceleration in inflation as if these wars in the Middle East and with Ukraine just get out of control, we could see a higher inflation, not lower. I don't want to see that, of course, but that's the risk in the system right now, the way I see it.
So that's a really pretty picture that you've painted for us here. So I guess the question, though, then, for investors is, what do we do about it? So if inflation is going to continue to be a problem, then dollars are going to be worth less. We've got to do something with them. Where do we put our money?
Well, people want to put it in real assets, and that's partially why people had a rush to real estate during the lockdown. And there was other reasons as well. Interest rates were so low that your monthly payment came down and made housing more affordable. And then what happened is people started to bid up the price of houses aggressively, and in some markets, the price of real estate went up 30-40%. So they were dumping dollars and buying hard assets. Another hard asset you might want to, and they were buying stocks as well, particularly tech stocks and things like that, which they're still doing, growth stocks. One of the things they've really ignored, but I think might be a nice idea now, is natural resource stocks, particularly the big mining companies, big diversified mining companies like BHP Group, Rio Tinto, Vale down in Brazil. Now, Brazil presents an interesting situation because they have some political turmoil going down. So their stocks as a country are historically super cheap. So if you think their politics are going to settle down, it's going to be a great place to invest. But if I had to pick one of those companies, I would pick Rio. Now they mine copper, iron, a little bit of diamonds, gold, silver, platinum, palladium, molybdenum, iron ore. If I missed that one, but essentially the whole suite of things that hurt when you drop them on your feet and that they pull out of the ground. And they're, I think they're, if I recall, they're operating in 25 different countries. So they have a nice diversification of country risk there as well. And the last point, I think they're trading at something like 10 or 11 times trailing earnings, which seems to me, if you've got a carrying earnings yield of about 10% and the potential for growth in earnings due to higher prices of all these different natural resources, seems to me that might be an interesting place to put your money. I recently wrote about the natural resource stocks over at the Options Edge.
So yeah, you bring up valuation. I think this is an important topic. How you think about valuation. So looks like the full year adjusted EPS estimates for Rio are in the neighborhood of $7.29 a share. It seems like the street's estimate is that falls a little bit full year 2025, maybe down to $7.20. I don't know what currency impacts are. Versus, we'll call it a $67 stock price. Is that about where it closed? Let's see. 66 and change, something like that, if I remember. Yeah, so almost 67 bucks. Actually, the stock's outperformed today pretty handily, right? So 66.78, to your point, that's a little over 9 times earnings. So how do you think about valuation? Because we can't just look at PE, can we? One static number. No. That doesn't tell the tale.
Yeah, PE is sort of a whole bunch of things rolled into one number. But if you were to take a look and what really drives that number, it's two things. It's risk to free cash flow of the company, and it's growth rate. So if the uncertainty of their cash flows is high, then the let's call it the discount rate on the cash flows. I think about stocks as bonds with a variable coupon. The more money they make, the bigger the coupon I'm going to get. So the more variable that number is, the higher your discount rate, and so that lowers your price. It's also subject to the general level of interest rates, right? If interest rates go up, the discount rate goes up and valuation goes down. But that's often offset by growth. So the faster a company grows, the higher the PE ratio should be on a stock. So the higher the discount rate, the lower the PE. The higher the growth rate, the higher the PE. And those things kind of play off each other. And I think that's the dynamic that took place after 2020 or 2021, when we had a sharp sell-off in stocks as interest rate rose. And then people realized, well, earnings growth and free cash flow growth is going to continue to go and maybe even speed up a little bit. and that overwhelmed the interest rate effect, and that's why stocks are trading very near their all-time highs and above their pre-COVID-19 highs.
So, it stands to reason that obviously we care what multiple of earnings we're paying and how fast earnings are growing. How should investors think about that relationship? The PEG ratio. What represents a good PEG ratio? How should people think about it? What is a PEG ratio? For those that don't know, maybe you could describe that for them.
The PEG ratio is investors' attempt to try to normalize PE ratio for a growth rate. So they will take the PE ratio, let's say it's 25, and if the company is growing at 10% a year, then they take the 25, divide it by 10, and they get 2.5. So if you were an old Peter Lynch fan, he always looked for companies. His formula was medium-sized, fast-growing companies that had PEG ratios of less than 1.5, and he really loved them if it was less than 1. So there's not a lot. There are some companies that fit that bill today, but certainly not as many as when he was managing money. But yeah, it's an attempt to just adjust the PE ratio for the growth rate that we see, so that you can compare a software company to, let's say, a food company that have massively different growth rates. Kind of put them on the same basis.
I mean, I guess since company operations can be a little volatile from 1 year or 1 quarter to the next, one year to the next, how important is something like price to sales, or how do you think about price to sales and sales growth? How do you like to think about margins and how those can fluctuate? What are you looking for there? Because I think, I'm not sure, but a number of companies that I've seen, it appears that their earnings have been growing much faster than their sales have been. Some of that possibly due to things like buybacks. I guess, how do you think about those aspects? How do you compare price to sales and sales growth to EPS and EPS growth?
Well, I'm not a big fan of price to sales. I'm a bigger fan of price to enterprise value to sales as a better benchmark. I like enterprise value because you're comparing sales, which are cash flows that eventually end up in the hands of both debt and equity providers to the firm. So I prefer that ratio. And then I like, it's really going to be dependent upon industry and growth rates again. So if you're talking about a software company, let's just call it price to sales, because a lot of people do look at that. They're often north of 10 or 15%. If you're talking about an industrial company, it's going to be something closer to 2, 3, or 4 is a more normal number. Again, it's growth that matters, and the need for reinvestment. Industrial companies need to recycle a lot of their earnings to keep their factories going, whereas software companies just need to write a little bit more software, upgrade their software, and it's not as heavy a lift in terms of reinvestment rates.
So I know a lot of the people watching, I mean, some surely just trade stocks, and you mentioned Rio, but many of the people who are watching probably also trade or use options for their strategy. Maybe we can try to work through an example using Rio of an options trade that you might consider in a situation like this. And I'm just going to take a quick peek at the event calendar here for Rio also, just so we can see what's upcoming, if anything. Let's see here. So we just had, I guess, sales and revenue release yesterday, and that probably helps account for the fact that the stock is up decently today. So options premiums, usually when you have a catalyst like that, the options premiums will fall and you will see realized volatility rise. Now, I bring this up partially because oftentimes people like to look at how expensive options premiums are relative to their history. But I guess it kind of matters when in that history you're looking at. Did they just release information? Did they not? If they did, you might get a spike in volatility. That's actually what we've seen. So just looking at this chart, the white line represents the price of 3-month options in Rio, and the orange line represents how volatile the stock has been on a rolling 20-day basis going back in time. And when you have a catalyst, you're going to usually see these types of spikes. Are you more in favor of just an outright long option strategy in a situation like this, a short option strategy, perhaps some hybrid, like a spread of some kind? What would you look to do?
Since I'm thinking this is a secular kind of move, that we could have higher commodity prices for the next year or two, perhaps longer, but at least that long. I'm inclined to either one, just buy the stock outright and let it move higher. The next thing I might look at is skew, and maybe a risk reversal makes sense here. So if the downside puts give you some extra juice, maybe you want to sell those by calls and buy this, get into the stock in a little cheaper fashion that way.
Do you look to technicals to identify what strikes you might use for a risk reversal? Maybe we can work through an example. I think I'll pull one up over here.
What I'd like to do with a risk reversal is, if possible, I'm hoping that I can't quite see the screen so well. So say the implied volatility of an out of the money call is 25, but it's 30 for an out of the money put. I would try to find some strikes in which I could collect just a little bit of premium by doing that. And so the reason why I like to do that is that if the stock goes nowhere, I'll make a small amount of money to pay me for my trouble. But if we start to get a change in psychology where people think, hey, inflation's not transitory, we need to start thinking about investments in some of these old economy things that we typically do well or historically have done well in inflationary periods. Then you want to be able to have something goes for a nice ride. So I see you've got one there on the right-hand side.
We talk about call spread risk reversals from time to time. I'm just doing a straight risk reversal, kind of what you talked about, selling an out-of-the-money put, buying an out-of-the-money call, and this one, which would expire in 65 days. I'm looking at the June 65 72.5 risk reversal, selling the 65 puts, buying the 72.5 calls, would collect, mid-market, give or take, about $1.10 per share right now. So that would represent about 1.65% of the stock price. So on a standstill basis, you're going to collect 1.65% of the stock price over the course of the next 65 days.
Right.
So we could annualize that. Yeah, I mean, it's not quite 6 times, but maybe I'll just say 5.5 times that number. That gets me an annualized standstill rate of return of about 9%. And if the stock falls, it would need to fall down to this downside break-even of 63.90. And if we take a look, So you'd effectively, if you have the stock put to you, you're going to own it around the 63.90 level, which, as we can see, is towards the lower end of the trading range over the course of the last year or so. Also appears like the stock does seem to have sort of come off of these March lows and has been trending fairly nicely since. And this one has been outperforming the market over that period too, I think, hasn't it?
I don't know the answer to that question. I think it's turned, and so I like the idea because I think there's potential for a lot of upside. Everybody wants tech stocks, and everybody wants the Magnificent Seven or whatever basket of high-flying stocks that you want to talk about. And these mining companies are hated. I can't tell you the last time I have heard you guys talk about this, for example, on Fast Money, or in general conversation throughout the day on CNBC or Fox Business or Bloomberg News or all these other financial medias. They're just not talked about. And so if there's any kind of shift in sentiment, I think much higher prices could be on the floor. The other thing, of course, with options is timing. If you think you need more time, maybe you want to go out a little bit more than, what did you say, 65 days?
Yeah, it was 65 days, but it pays a standstill rate of return of about 9%. So I guess that's kind of the trade-off, right? So if you are in a trade that has a standstill rate of return, that means you're collecting premium. On balance, you're collecting premium. Time is your ally, but it is going to pay you more quickly as expiration approaches because the options are going to expire more quickly. I just happened to look it up, by the way. Rio has outperformed the S&P since March 15th by about 9%. 9.22% actually is the difference. But I don't really think you're chasing the rally early here because this thing is still well below the levels that we've seen recently.
Right.
I think this thing was 72.5. It looks like back in December of last year. Rather interesting to me that other areas, U.S. stocks in particular, have outperformed. What do you make of the issues that are going on in Brazil? I think this is maybe it's gotten more attention, especially net of what's going on in the Middle East, because we have a tech billionaire, one of CNBC's favorite topics. I appreciate you lumping me in with that group, by the way. You guys always talking about tech stocks. Look, sometimes we talk about the things that people ask us about, which, by the way, if you're watching, be sure to throw, if you have questions or comments, especially about things like crypto, which I know little or nothing about, for Mark, be sure to put those in. What do you make of what's going on in Brazil? What is the real threat there? I mean, I know that in the case of Elon Musk, it has a lot to do with free speech. And are they going to shut down social media? Mm-hmm. Why would they want to shut down social media? And is there any kind of risk of nationalization? Isn't that something that happens from time to time? And that's one of the reasons that natural resource plays tend to trade at a discount?
It is. I think there's a move afoot by those that are in political power to accumulate more power in the government. So a move towards socialism, if you will, and them taking more control of the economy. And of course, when that happens, typically the government doesn't want people to object to what they're doing. So that's why the free speech gets taken out back and roughed up, and so that's it's sort of from the official playbook. So I think that's what's going on. Will it grab a hold? I certainly hope not. That's been the bane of Latin American countries. They've tended to embrace Marxism a little too much, and it's hurt them. So Javier Milei is really turning the corner, and I think he's been in power 2 months now. This is Argentina, by the way. He's already got the government running a surplus. Took him 2 months. And as he quickly reforms the economy, I'm hoping that things don't get too bad. Brazil has typically been a pretty good place to do business. They are just massively natural resource rich, and I know lots of Brazilian people, very bright people, a lot of ingenuity there. So I hope for the best, and I don't. So that's why, you know, if you wanted to take a stab, you go in and buy a Valley because they're trading at about 6 times earnings, and I think that the market has priced in that risk that you talk about, that there could be some kind of nationalization or closet nationalization, which means just a massive increase in tax on the company.
Well, let's take a look at one of these other natural resource plays that you were just talking about. I think BHP. Yeah, that was one of the ones you were considering. So we can take a look at that one first, I guess.
Yeah, terrific company. When I was in my ANZ days, we did some financing for the company. They're a core customer of the bank. Of course, they're headquartered in Melbourne, Australia, and I think an extremely well-run company and very disciplined with their capital allocation. So I think it's a very good company. I just chose Rio because it's trading at a lower PE, and I think the growth rates of both companies are going to be similar. So in that environment, I want the one with the lower PE ratio.
Yeah, the top line growth for both looks. The top line growth for both looks very similar. Do you think that the difference in valuation that we are seeing here is mostly a function of those geopolitical risks that we have in Brazil?
I don't know. Rio is, as I mentioned, I think in 25 different countries. BHP is in a lot of different countries as well. I didn't look up the number before I came in. Its Valley is the one that is really Brazil focused, and so it trades at a big discount. It looks like they're pretty well diversified, but they got revenues there where their assets are located. Their mines are located. I don't see it there. If the company, I don't suspect the company's changed a lot. Now, their biggest allocation is going to be Australia, of course. Australia is another super natural resource rich country with a lot of highly industrious and intelligent, hardworking people there as well. And they really know the natural resource business.
What are your thoughts on Petrobras now that we're sort of talking about the natural resource business? So, I mean, we're talking about Brazil. This is, I mean, it's not a miner. It's a different kind of resource play. Yeah,
they're oil and gas. That was also a big customer of ANZ when I worked there. I don't know if it is now, but I worked there a long time ago. At the time, they were a very good customer of the bank. Very easy to deal with, honest, ethical. So we did anything from offshore oil and gas, drilling operations to power. They do have a power business as well.
Do you like the company?
I don't know if you could
look up. Oil?
Could you take a look at their multiples real quick, Mike?
Yeah, I mean, it's, the U.S. shares are about 15.70 as of today's close. Adjusted EPS estimates for the full year around $1.72. So, I mean, this is another single-digit multiple name. Also trading around 9 times, which is, not, it's probably in line with where Rio is.
Yeah.
And, I mean... what do you think of oil here? Also, I think that's another question with all of the turmoil that we've got going on in the Middle East. I think it was yesterday or the day before, and I'm hoping this isn't true, but I did see, this is going to affect U.S. markets a little bit more because WTI trades at a discount to Brent. But the Biden administration recently suspended their repurchase plans for the SPR, which so they had sold off a significant portion of the Strategic Petroleum Reserve, the biggest drawdown, I think, in the Strategic Petroleum Reserve's history, which was, if memory serves, created by President Ford, took place in the spring from spring into the, basically the end of the summer of 2022, around the time of the midterm elections, right? So looked like there was an effort to keep a lid on gas prices. Mm-hmm. They have not replenished the SPR, but we have another election coming, and oil prices have surged recently. And so it's hard to imagine that the SPR would see further drawdowns, but they did suspend the repurchases which they had previously signaled. I mean, what are your thoughts on crude here?
I'm bullish crude. I think it's going much higher. The government has made it harder for us to drill, certainly on federal lands here in the U.S. And so that's a bit of a downside. I think it was a mistake to run down the Strategic Petroleum Reserve simply to manipulate price. It's really there for when there's a market dislocation. There's some kind of natural disaster or geopolitical thing that disrupts that supply chain, and then that's really what it's there for, not to manipulate the price up and down. I'm disappointed that when the price did go down, that they didn't rush to try to replenish it as much as they could. They didn't. I don't know that they've bought anything more than a few million barrels since they ran it down. So that makes the country vulnerable to if the Middle East situation gets crazier. While a lot of that oil doesn't come here, it goes to someplace else. Oil is priced in the world markets, not just the U.S. market. So if they go up higher overseas, then there's a tug for U.S. producers to export their product to where they can get a higher price. And of course, that means a higher price here in the U.S. So the surprise, if there's going to be any surprise, to my mind,
so I'm just going to show, this is an interesting chart, and then I'm going to try to grab a couple more questions because we've got some good ones here. So this chart, for those who are interested, the white line represents the Strategic Petroleum Reserve, which hit its zenith in terms of the amount of oil that was held in it, about 725 million barrels. That was in 2009. As we can see, oil prices, that's here in blue, at that time, this is from 2000 up through 2008, they were building the Strategic Petroleum Reserve even as the price of oil was increasing. And I'm assuming that it's called the Strategic Petroleum Reserve, right? So it should be strategic. I'm assuming that the strategy that the administration at the time had was that we were engaged in prosecuting a war in Iraq at the time and subsequently Afghanistan. Probably seemed like a good idea for us to have some excess oil. It's also interesting to see that even as oil prices reached the highest prices ever, that they were still building.
Yeah, so that during that time period was when the idea of peak oil was running around the marketplace, and that's why we saw that super run up to, what was it, about $140 a barrel. The idea there is that globally, all the oil that could be found has already been found, and it's just a matter of time for it to be depleted and where mayhem in the world and all this other insanity was sort of a meme. So everybody was sort of diving to buy some oil and gas stocks, some oil futures trading went a little wild there, and of course that turned out not to be true. Fracking unleashed a great deal of production. One of the summer jobs I had as an engineer was working in the oil fields of Bakersfield. State of California sits on a huge pile of oil, but it's all like tar. It's really hard to get out of the ground. But most people don't realize there's only about a third of the oil that's in the ground can be pulled out of the ground, because it's stuck in rock and other kind of stuff. The fracking allowed for a little bit more of that oil to be pulled out. And of course, we have all this shale. There's a huge amount of shale in the U.S. They'll be able to produce for decades. So that fear kind of went away, and therefore that's why prices are kind of well behaved. I don't know what the number is, but I think if we looked at the real price of oil, so take the price of oil and discount it by inflation in 1970, it's probably not a whole lot higher. It's fairly priced,
Yeah.
but I think it's going higher because of all this geopolitical stuff and this political move to try to get away, make it harder to do anything in the oil and gas space.
So there's a question here for you. Can you talk about hedging inflation with crypto? Seems like this last Bitcoin pullback, the hedge was not working. Thoughts? And actually, we've seen gold. I mean, gold's been doing well. Gold was down today, but that hit all-time highs this week.
So there's a lot more going on with Bitcoin than just an inflation hedge. If the price level goes from 100 to 120, if Bitcoin was inflation hedge, it would go up by 20%. But that's not what it did the past 3 years. It went up by a 3x, I think, or 3.5x. So there was a speculative component in there as well that I think is even larger than the inflation component. It's a small market. I guess you could call it a market cap, is about $1.4 trillion. You compare that to the amount of currency on the planet of being about $90 trillion. If there's any kind of movement from dumping the currency you have in hand and buying Bitcoin, there's a lot of leverage there. It doesn't take a lot of selling of traditional currency and buying Bitcoin or Ethereum, whatever, that was going to drive the price substantially higher. And that process is just going to continue on through time, I think. As the number of people that have a wallet is only a few hundred million. So as people come into it, there's just going to be a natural force to move prices higher. And the people that are embracing it the most are young people on the planet, particularly those that are in countries that have unstable monetary policies like Nigeria, Indonesia would be two that come to mind. That there's a movement afoot to do that. So, it has the greatest benefit for those countries that have undeveloped financial systems, their payment systems.
What about the upcoming Bitcoin halving?
Well, the supply, the additional production of Bitcoin is going to get cut from 6 1/4 every 10 minutes to 3 1/8 every 10 minutes. And that's going to make some interesting dynamics because a fair number of miners are not going to be profitable or they're going to have mining rigs that won't be profitable, so they'll shut them down. So it'll be interesting to see if they can remain profitable or if they'll end up with more consolidation in that space. But it should help propel prices higher because slowly more people are coming into the market and the supply of coins to pass out to folks who want to buy them is growing at a slower rate, and it will continue to grow at a slower and slower rate as time goes on. I think the last Bitcoin will be mined in 2140. But I think the big thing that is happening is bigger than all of this is the ETFs, because it allows traditional money, things like family office money, pensions, sovereign wealth funds, all these big pockets of capital to come in and buy. Is that infrastructure of holding will be in place. Fidelity and Coinbase and others will custody these folks now. That to me is where I think you'll see a substantial outperformance relative to inflation. So
do you own
massively outperforming inflation? I think that continues.
Yeah. Do you own any other cryptocurrencies? Because I think you mine a couple different things, right?
Yeah, I have, and I mine them for the school, and I have a little bit of mining. I've got a couple little ones behind me here that I turned down because so they're not those little gray boxes there. So I actually use them to heat my home. So when winter comes, I turn them on. And I didn't run my furnace this entire winter. I'm in New Jersey, so we didn't have a really tough winter. So it was nice to know that I did have a furnace in case I really needed it. But
so the heat your mining machines generates is enough to heat your house?
It is. I have another one. It's called a Heat Bit, and it's a relatively new company that's a space heater. And it looks pretty nice, and it not only provides heat, makes Bitcoin, but it's also an air filter. It's a new company located down in Delaware. Some nice entrepreneurs are making some things happen.
So we just pivoted from natural resources to crypto, and now to the machines that are mining it for you. And one of our viewers just asked us, Taiwan Semi, running Donut asks us about Taiwan Semi earnings tomorrow. Any thoughts on that? This one is not implying any real move at all. And by the way, because Taiwan Semi is based overseas, I believe they actually report at 2 a.m.
Oh.
So it's an overnight kind of a thing. But so today's the 17th. Do they report to? I'm trying to remember. Is it 2 a.m.? Yeah. So it's going to be overnight. I don't know if this is tradable now that I think about it. But what do you think of Taiwan Semi here?
I like the stock. I certainly love the company. The valuation I'm less certain on. Where is the peak multiple right now, or the EV to enterprise?
So right now, yeah. So basically, the enterprise value and the market capitalization are not far off of one another. The company has about 20. Looks like it's got about $24 billion of net cash. So $640 billion market cap versus a $620 billion enterprise value, with adjusted EPS full year at about 30.7 billion. So did I say EPS? Sorry, I meant net income. That translates to just about $1.20 in adjusted EPS. I too like the company. They've been growing. They've been putting facilities stateside, so they're de-risking their geographic risk with respect to China. So what does that work out to? Let's just call it $620 billion, round numbers, $620 billion in enterprise value, 30.7 in full year cash. It's actually 20 times earnings, but growing adjusted EPS at 15 to 20.
So that would make
looks
the
pretty
stock
good to
cheap.
me.
Yep, that makes the stock cheap. I think what I would keep my eye on to see if they say anything about the margins they're getting on the NVIDIA chips they make. So NVIDIA charges a huge amount of money. Their margins on their GPU boards is something approaching 90%. And I'm wondering if, how much Taiwan Semi is able to share that super high margin. That's what I would probably be focusing my mind on as well. But I like the stock. It's a great company. They are so core to technology, and Intel is running as fast as they can to catch up to them, because they want to be a fab as well, get back to their roots of not only designing chips but manufacturing chips for themselves and others. So, but
it's had a big run. Do you think would you do like a stock replacement strategy? Maybe buy a longer dated, maybe buy a June, July call spread, something like that. I mean, the stock has had a heck of a run off of the October lows around $85 a share. I mean, it is reasonably valued. So if you own it, I'm not suggesting sell it or anything. What do you think? If you were long the stock, would you pivot to an option strategy here, or would you write some calls? It looks like.
What does the implied volatility look like?
Yeah, so the implied volatility right now, and we'll compare it to the realized number as well. So the implied volatility is pretty high. It's about 40 for 3-month options. And let's take a look at what it is like in the 1-2 month time frame.
With a high volatility, and if I didn't own the stock, I might sell a put spread. And take advantage of that elevated volatility. Now, if I own the stock, I might write an out of the money call, but since it's got a lot of tailwind, I really hate to do that in this kind of environment, because they got a big tailwind, and people are, I'm sure, we're looking for reasons to buy the stock, and I expect them to report a decent number. I don't know enough about expectations to say if they're going to have a beat or not, but I'm sure whatever.
It's interesting. I'm looking at the covered call situation. If you sold the May 155s, that's giving yourself a decent amount of upside relative to where the stock is currently trading. I mean, that's the 155 calls, which, by the way, you're collecting a decent amount of premium on that as well.
You picking up?
To me, yeah. So you're going to collect about $2.50 for a 155 strike. So that strike is 11.5% out of the money. If you do get called out of the stock, you're going to be getting called out at 157.5, again, round numbers. But 157.5 over 139. So that would be, it would be almost a bad outcome for having written the call, but you almost feel like you'd be happy to have that happen to you. You're going to make 13.3% over a month.
Right.
So that might be something to think about.
I like, that's a possibility. That's why I was thinking about that with an elevated vol.
Yeah, I'm going to ask you one other question. It's definitely not a name that I probably would have been thinking about. We talked about natural resources. We talked about oil. We talked about crypto and technology. Charlie Echo November X-ray, which is Century Aluminum. It's funny because I think we've talked about industrials and materials and things like that. we always would talk about these kinds of things. 20 years ago, Alcoa was one of the, typically the earnings season, which we've just started to kick off. But Alcoa used to be the first name to report. Now we kind of think of them as the banks. But you have any thoughts about something like this? It's been a struggle for American, aluminum and steel producers because we had to contend with dumping. That was a problem. And
Right.
Recently, I think Janet Yellen, it was a couple of weeks ago, she was in China, and she came back. But one of the messages she gave them is, we're not going to tolerate Chinese dumping and basically trying to put our businesses out of business. She was really referring more to the green industry businesses. So I think she was basically saying, don't dump solar on us. But what do you think about something like aluminum? We've got a guy asking.
I don't know this company very well. I know Alcoa. It's a very important industry because it's used heavily in aerospace, for example, and a lot of car parts. But the fabricators have had a hard time getting a decent return on capital. So I am probably not very excited about that. And it's an area that is hated. Where's U.S. Steel? It's not aluminum, but I think they trade at 6 times earnings, and I would guess these guys trade at a very low multiple.
Yeah, well, in Century Steel's case, the street's very forward-looking. They're kind of expecting them to, to start making some money, not full year 2024, but 2025. U.S. Steel right now, which closed 39.13. That's obviously pretty cheap compared to the, 338. It looks like the street's looking for full year 2025. Now, the company, what I find interesting is that some of these businesses actually made real money and not that long ago.
Yes.
So it's kind of fascinating to look at a business that's trading $39 a share and look back to full year 2022 and see that they made $10.50 a share. So this is, it's trading 3.8 times the adjusted EPS from just 3 years ago. It's kind of a fascinating thing. Anyway, I really enjoy these conversations. I'm really looking forward to the next one. I appreciate the patience of everybody who sticks around to hear. Obviously, listening to Mark is always insightful, and I appreciate it. Listening to me probably gets tiresome, but you guys managed to hang in there for an hour, believe it or not. That's an hour you won't get back, but I hope it's an hour you got something from. We really appreciate you watching. Like, subscribe, send us more questions, send us more comments, and we'll try to answer them in the next one, which is going to be on Monday at 4:15. Thanks for watching.